more confident now that crypto assets are going to rival and redefine traditional asset classes. Crypto assets being valued at the end of 22 at roughly 1 trillion. We could see 25 trillion, a 25-fold increase by 2030. I know that our Bitcoin price got a lot of press this week, our price forecast. And yes, we are recommitting to the $1 million. Of course, we've had to take assumptions for corporate treasury uses of Bitcoin on balance sheets and nation state treasury uses. Those have come down a bit. But still, we do expect our base case for Bitcoin for 2030 is almost $700,000, and our bull case is roughly double that for 2030. So you can see the building blocks in big ideas. You can take a look at our analysis of smart contracts and Ethereum and how the merge is now causing actual deflation in the number in the rate of increase in the number of ether out there. In other words, right now Bitcoin is inflating at roughly, I think, 1.7%. So the supply 1.7% per year as it moves towards its mathematically metered 21 million units. And Ether, I think, has just moved into a decline in Ether. That's quite a robust statement right there.
Bitcoin's bull market is likely to start earlier than expected due to anticipation of the BTC halving and favorable macroeconomic conditions, according to Mark Yusko, founder and CEO of Morgan Creek Capital Management. Hello and welcome to Money Talks. In today's video, Cathie Wood, CEO of ARK Investment Management, updates about the recession fears and the current market cap of the crypto industry and reaffirms her firm belief in disruptive innovation.
Expectation was, especially after the ADP report earlier in the week that said, according to its analysis, employment was up only 108,000 in the month of January. And expectations for non-farm payroll were 188,000. The number was 517,000. The expectations were 260,000. Last month was 188,000. The number came in at 517. The unemployment rate dropped to 3.4%, a level we have not seen since 1969. And weekly hours were shocking. They were up 0.3 hours. That rarely happens. Rarely. Now, again, seasonal factors probably an issue here. But what it will mean if you combine that with average hourly earnings, which were well controlled, 0.3% expected, 0.3 delivered, that puts the year-over-year wage inflation at 4.4%, which is still less than the CPI inflation, so no wage push inflation there. But the combination of hours worked and average hourly earnings means that income boomed, especially when we incorporate the revisions to previous months. So income is probably in the month of January up in 1 month's time, up roughly, it's somewhere between 1.5% and 2%. That's just a sequential increase. So that's, 15% plus at an annualized rate. So that's a boom. It doesn't square with what we're seeing out there elsewhere. We're seeing the challenger job layoff rate up 400% plus in the month of January. We are hearing, the headlines are screaming layoffs. Listening to earnings reports over these last few weeks, one layoff announced after another, or hiring freezes at best. We're seeing the banks take reserves for bad debt. big increases, like billions, $1.5 billion, I think, for JP Morgan. There were a number of $1 billion increases. Just in the last few days, we saw reports from Amazon and Alphabet, Meta, Apple, Microsoft, and all of them were showing serious weakness. And, advertising is one of the most discretionary of expenses. That actually started weakening dramatically nearly a year ago. And as you know, we believe we were in a recession last year. And sure, we've gotten a bit of a reprieve. But if you look at what happened in the fourth quarter, the GDP statistics, we did get those the preliminaries. Inventory accumulation accelerated in the fourth quarter. And we thought that retailers were discounting so heavily because they were trying to clear shelves. Well, consumption, if you look at the retail sales reports, consumption looked terrible. Now, services bolstered consumption in the GDP reports, but goods consumption was very weak. So, what we're seeing from this employment report does not square with reality.
The next crypto bull market will start sooner than most people think, according to Mark Yusko, founder and CEO of Morgan Creek Capital Management. Yusko thinks the next crypto bull run, or as he calls it, the crypto summer, could kick off as soon as the second quarter of this year due to the combination of more dovish central bank policies and the anticipation of the Bitcoin halving. While the United States Federal Reserve is unlikely to cut interest rates anytime soon, according to Yusko, the markets tend to anticipate the Fed's decisions. That means even a slowing down or a pause in interest rate hikes would be interpreted as the signal of an imminent pivot. That would spark a positive dynamic among all risk assets, including crypto. What I do think is very likely is the Fed signaling that, okay, we're good. But that will be interpreted as, we're going to cut, and then risk assets will explode again, Yusko pointed out. The market always anticipates the halving. 9 months before that is usually when the beginning of summer starts, Yusko said.
It up by saying we focus a lot in this big ideas on technological convergence. So this means, S-curves feeding S-curves. So I just described cost declines causing an S-curve. You have cost declines in sequencing causing an S-curve there, and cost declines in artificial intelligence causing an explosion in demand there. And in the genomic revolution, you've got both sequencing and artificial intelligence at work. So you've got an S-curve feeding an S-curve, and we think explosive growth going forward. So we spend a lot of time on convergence, and Brett Winton, our chief futurist, has some fantastic illustrations here on the kinds of convergences that we expect. And he also focuses on we've grown up in a linear world, really the last 50 years. And if we're right that we're entering into an exponential growth world, then real GDP growth should kick up here. If you look at the consensus forecast between now and 2040, you'll see it averages, this is real GDP, about 2.6%. If we are right, and these S-curves started feeding S-curves, and these new technologies start to be, are integrated into our everyday life, they go mass market, the forecast that would be consistent with technological history and consistent with these new technologies would not be 2.6% GDP growth per year, but more like 8.5% GDP growth per year, with growth between now and 2030 being roughly 6.1%, accelerating thanks to super exponential growth to 10.7% between 2030 and 2040. So look for the convergence piece. and learn more about how economic statistics are going to change. They're all going to be lagging this. That we know. It's already happening. But it's going to happen more and more going forward, meaning we will have to be much more skeptical about the economic statistics, the readouts that we're seeing, than we have been historically. We go into AI and training costs that are dropping at a 70% annualized rate when you analyze both the hardware and the software involved in AI. Think about that. If you cut the cost of something 70% per year, you're going to get a lot more of it. And just to give you a sense of this, GPT-3 performance, it cost in 2020, just really 2 to 3 years ago, it cost $4.6 million to train a model with GPT level performance. Today, it costs $450,000, and by 2030, we think it'll cost $30. So we're going to see artificial intelligence impact every industry, every company, and companies not harnessing it are really going to lose out. And the biggest impact, as I mentioned before, is going to be on productivity. And we do believe that there's a $14 trillion market out there by 2030 for companies to harness and for productivity, to enjoy the productivity lift that we expect. And that forecast, that 14 trillion, is associated with a fourfold plus increase in productivity.
So, do you think it is a good time to invest in crypto? Tell us in the comments. Also, don't forget to like and subscribe. See you soon with the next video. Thank you so much for watching.